Here we have a backup to the edge of the creek setup. Your futures on a 60-minute time frame. First thing, what do we know? Well, we have a trading range, lasts for 3 days or so. Pretty good for a 60-minute time frame. We break resistance here, the creek. We get a good rally, we break with these, and then we come back down to test, giving us the backup to the edge of the creek. However, slightly more to this chart than meets the eye, as we can combine a few concepts. All I've done is shown the inclusion of this channel. This is a mini trend channel that holds for 15 hours with multiple touches, so we know this is valid. This is a nice, slow, orderly pullback. Then all of a sudden, what happens? We fall out of bed, exactly like a selling climax. So we could call this, it acts in the same way as a selling climax. So we could call this a shakeout or a selling climax. Again, we don't need to label it. All we need to recognize is the behavior, that it falls out of bed. And what does it do? It slams down to reverse and close back above support. So this climactic bar or shakeout bar is the test, and look how the test originated from a nice orderly downtrend. So we're combining multiple concepts and principles here. The most important thing about this slamming down is the close. We dip under deep into this price action, into this trading range, to reverse and close firm back over. This is a huge tell. Think about what this bar achieves. The action on this bar would trigger many stops. Look how far we penetrate deep into the trading range under all this price action. This would trigger many stops, many resting orders, and induce bears to sell. If we're coming down like this, at some point this bar would be like this, and people have FOMO and they're going to join on. They're going to join in trying to get some of this action because they have no patience. Then there would be stops here naturally. It's only natural there would be stops. Why? Well, if you think about it, people are buying here, buying here, buying here, buying here. They're buying all along here. And this is a 60-minute time frame, so they're buying for over a day. And if you're buying here, where would your stop be? It would be under support. You wouldn't put it under here. I mean, that perhaps that would be the correct place, but it is too far. And for whatever reason, there must have been perhaps a large order, and they slam it down. This is what they do. They slam it down, trigger the stops, induce the bears to buy all their contracts, and it closes back above support. This is phenomenal. It's a very good climactic shakeout bar. Label unimportant. And look at the response. Look at this response. Huge widespread, huge volume, closing firm, and we continue north. We never look back. So we have amalgamated a few concepts here. We have a trend channel where we get some climactic or shakeout bar, which actually is the test for the backup to the edge of the creek setup. And we note buying. When we have buying behind us, we get a good drive up. So we recognize this behavior as actually strength. And if you're a very good trader, or should I say, if you're an extremely aggressive trader, you could buy this. Not that I would. It's still too ambiguous. This is, you know, a scary bar. Don't get me wrong, but we do slam out. But the close above, odds do favour higher prices, and you pay for confirmation, which is okay. We don't get every market turn. So how would you trade this? Well, if you're aggressive, you trade this. You could play it safer, and when we take out these highs and we break the supply line and look at the spread here, we could note at that moment in time as we're breaking, it's probably one of the highest spread bars on the chart apart from here, and we would see the volume increase, so we could let the market pull us in. We could buy stop here. But the correct play, or should I say the safe play, is here. Wait for a break, and then we get a lovely little spring bar here, and we could trade that using lower time frames on a 5-minute or a 15-minute time frame. We'd either look for a lack of supply at the lows, and as we reverse through, we'd want to see demand enter. We can get in closer to the market with a smaller time frame, and obviously our stop would be the lows. Are there any questions for this chart?